So here's something almost no other $6 billion coin can say. Right now, some of the biggest names in finance, JP Morgan, Goldman, Visa, DTCC, are quietly settling trillions of dollars a month on one network. And the coin underneath it all, Canton Coin, sits up around rank 19, yet you cannot fully see what happens on it. Not because it's hiding anything, because it was built on purpose so that no one, not even the network itself, ever holds the whole picture. And that one choice shapes everything about this token: the supply, the burn, the famous deflation, who's in control, what it's really worth. So let's open it up. Honestly, no hype, straight off the ledger. This isn't a 101, it's the tokenomics, audited. And by the end, I'll hand you one number that tells you exactly where this whole thing is headed. So let's get our bearings. First, the bearings. Because Canton is really about six different things people cram into one word. Canton Coin, ticker CC, is the token. Almost 39 billion of them. Canton Network is what it lives on, a public web of connected blockchains built for institutions. Underneath sits the global synchronizer, the shared layer that keeps everyone in step. The software comes from a company called Digital Asset. They build it, they don't run it. Running it is 56 Super-Validators, names you'd know: Visa, DTCC, Goldman, Nasdaq, plus a nonprofit foundation co-chaired by Euroclear and DTCC. And the apps on top are written in a language called DAML. The coin, the network, the synchronizer, the builder, the validators, the foundation. Six things, one word. Hold on to those, because the whole story is about which of them actually holds the power. And to really get this coin, it helps to know where it came from, because Canton didn't start life as a coin at all. Digital Asset has been building serious financial plumbing since 2014, the team behind some of the biggest exchange and clearinghouse blockchain projects in the world. For years, that meant private blockchains, built one bank at a time. The catch? Those private networks couldn't talk to each other. Canton was the answer, a way to connect all of them without anyone giving up their privacy. The coin came later, in 2023, as the fuel that ties it together. Now, if you followed this channel, you've seen the pieces: the tech, the ETFs, the Zenith launch, the wallet layer. This is the one that ties them up. Not what Canton does, but what the coin actually is. So let's start with its most important idea: privacy. So picture one real trade. Somebody swapping 100 tokenized shares for $10,000 in cash, and it has to settle atomically. Both legs together or neither. On most blockchains, that whole trade gets written onto one shared ledger everyone can see. On Canton, it doesn't. Watch what happens instead. The trade gets dealt apart, like a hand of cards, and each piece flies only to the party entitled to it. The bank moving the cash only ever sees the cash leg. The registrar tracking the shares, only the shares leg. The buyer, the seller, and the app that brokered it hold both, because it's their trade. Everyone else genuinely has no copy, not locked behind a password, just not there. Now, something still has to put these in order, right? That's the synchronizer. Picture it as a blind mailroom. It sorts the sealed envelopes and stamps the final all or nothing commit, but it never opens a single one. And here's the elegant part. You can test the whole thing live. Trace the cash leg. It lights up in 4 places, and it's simply absent at the registrar. Trace the shares. 4 places, absent at the bank. No single view ever holds the entire trade. The whole only exists as everyone's pieces, added together, owned by nobody. That's not secrecy. That's privacy by construction. And it's exactly why the biggest institutions on Earth are comfortable building here. All right, now that you see how it works, let's audit the money. starting with supply. There are about 38.9 billion Canton coins today. And here's the first thing that jumps out when you rebuild the history. You can actually see a halving right there in the curve. Last November, supply was growing fast, over a billion new coins a month. Then this past January, the network ran a programmed double halving. It cut new issuance in half and dropped the validator's reward share from 48% down to 20%. And the curve bends. You can point to the exact spot. Net new supply fell something like 75%, down to roughly a quarter billion a month. The stated goal was to stay under 42 billion by this July, and the math gets there comfortably, near 39. So supply isn't fixed in stone, but it's decelerating on a published schedule, exactly as designed. And that sets up the single best part of this whole token, the burn. So here's the mechanic everyone calls deflationary. And what's really happening is so much better than the slogan. Every fee paid on Canton is charged in dollars, paid in coin, and then burned, destroyed, gone from supply for good. And it's not a token gesture. Basically, 100% of fees get burned. No treasury skims a cut off the top. It just vanishes. All time, that's about $483 million in fees, which works out to roughly 4 billion coins already taken out of circulation. Now here's the honest and frankly exciting part. Is Canton deflationary today? Not quite yet. It still mints about 20.5 million coins a day and burns almost 12 million. Put those together and you get the one number I promised you, the burn to mint ratio. Right now, about 57%. Canton burns 57 cents of every dollar it mints. And think about what that means. The day that number crosses 100%, Canton flips genuinely deflationary, burning more than it creates. That's not a hope. It's a finish line you can actually watch. Every halving pushes it closer, and the next one, around 2029, could be the one that crosses it. So if you remember one thing from this whole video, make it that ratio, 57, and climbing. So with that burn in mind, how should you actually value this coin? And here, Canton does something refreshing. With most tokens, you worry about fully diluted value. That scary number for when every future coin unlocks and floods in. With Canton, there isn't one. There's no hard maximum supply at all. So fully diluted value is simply undefined. And for once, everybody agrees. CoinGecko, Masari, even Canton's own blog all land in the same place. Fully diluted value just equals the market cap, around $5.9 billion. And honestly, that's clarifying. You can't get spooked by a giant hidden unlock cliff when there's no cap to dilute toward. So you don't value Canton on a made-up future number. You value it on what we just watched, the live burn and real usage. Which raises the next question. Of those 38 billion coins, how many are actually out there, truly floating around? Now the headline says 100% of the supply is circulating. And technically, that's true. There's no vesting quietly locking coins away. But the real, freely trading float is a touch thinner, in a way that's actually a vote of confidence. Here's the standout. A single Nasdaq-listed company, Canton Strategic Holdings, holds about 3.3 billion coins. That's 8.6% of the entire supply, over $500 million worth, sitting on one public company's balance sheet as a long-term position. And because they're public, you can see it right there in their filings. One company believed in this enough to make it their whole corporate strategy. On top of that, validators can voluntarily lock up their coins for bigger rewards, and that program's grown since April. Now, I'll be straight on one thing. There's no clean public figure for exactly what percent is locked, so I won't put a fake number on the screen. But the direction's clear. Real float is a bit tighter than the headline, mostly because big conviction holders are sitting still. So that's the demand side forming, which raises the obvious question. Who actually controls the rules here? Remember those 56 super validators? Here's what's genuinely interesting. Together, they don't just run the network. They can change its economics. The emission curve, the reward splits, the fees, all of it can be amended if two-thirds of them agree. And it's not theoretical. That January halving we just talked about happened through exactly this process, a formal proposal voted in. Now, you could call that not fixed in code, but look at what it really is. 56 named accountable institutions, Visa, Goldman, DTCC, and the like, each with an equal vote and a two-thirds bar to change anything that matters. No single one can push something through alone, and no anonymous whale can either. For a network built to settle real-world finance, that's not a weakness. It's exactly the kind of clear, accountable governance these institutions require to show up. It's transparent about who's in charge, which leads to a fair question for you, the coin holder. Where do you fit into all of this? And here's the honest answer. And to its credit, Canton doesn't hide it. If you simply hold the coin, you don't earn a direct yield. No staking reward, no dividend. Every coin the network emits flows to the people doing the work. About 62% to the apps building on it, 20 to the super-validators, around 13 to the validators, and 5 to a development fund. Holders just aren't on that list. But, and this is the key, that doesn't mean holders get nothing. Your value comes from one clean place, the burn. As usage grows and more coins get destroyed than created, every coin that's left becomes a slightly bigger slice of the whole network. So Canton was never a yield play, and never claimed to be. It's a usage and scarcity play. And once you know that, it's a beautifully clean, honest story. You're not waiting on a coupon. You're betting on the burn we already watched. So, the obvious test. Is anyone actually using this thing enough to make that burn matter? And this is where Canton flips the script on you. If you measured it like a normal crypto chain, by the value locked in DeFi, you'd find about $800,000. Sounds tiny, until you realize that's just the wrong ruler, because the actual settlement volume crossing Canton is around $9 trillion a month. Trillion with a T. This was never a DeFi yield farm. It's institutional settlement plumbing, and on that measure, it's already number one in the entire industry by fees. Now, the demand for the coin itself is still early, and I love that the data is honest about it. There are 2 ETFs now, one in the US and one in Europe, holding under $7 million combined. That's real money walking in the door, just small for now, only a few days worth of new supply. The far bigger buyer, by a mile, is that one Nasdaq treasury holding nearly 9%. So the picture's clear and kind of thrilling. Enormous real-world usage on one side, and a young, fast-growing pool of coin buyers on the other. The buyers are real, they're just early. Okay, let's put the whole thing together, honestly, like a scorecard. The burn? Strong. Nearly 100% of fees destroyed, real and verifiable on-chain. The supply? Decelerating on a published schedule, with no scary unlock cliff hanging over it, because there's no cap to dilute toward. Governance? Transparent and accountable. 56 named institutions, equal votes, two-thirds to change the rules. Real-world usage? Off the charts. $9 trillion a month. And then the honest, mixed parts, said plainly. Holders don't collect a yield. The deflation is a destination it's still traveling toward, and one company holds a big, concentrated slice. But none of that's a knock. It's simply the real shape of a network mid-transition. From a heavily subsidized institutional bootstrap toward a self-sustaining usage and burn economy. And the single number that tells you how far along it is that burn to mint ratio, 57% today. The day it crosses 100, the whole character of the token changes. That is your watch number. So what do you actually do with all this? Treat Canton Coin as exactly what the data says it is. The fuel for genuine, large-scale institutional settlement, caught midway through an engineered shift towards scarcity. It's not a yield play. It's not a governance play. It's a usage and burn play, with one of the most credible rosters of institutions in the entire space standing behind it. The supply's decelerating, the burn is real and climbing, and you've got one clean number to follow the whole story by. And none of this is investment advice. It's an education, so you can size your own view with your eyes wide open. And if this is the honest, no hype kind of teardown you want more of, do me a favor and subscribe. We do one of these on a different token every week. Tell me which network you want audited next, and I'll see you in the next one.